All right, perfect. We're going to go ahead and get started then. So today's presentation is regarding captives and health insurance. I try to put together a little bit of a different approach using the Simpsons, and I'm not talking about your family or uncle or aunt, but the cartoon that's been running for quite some time, because I thought after I was putting this whole thing together, it got a little dry and cold, and why not throw some more little fun into this? So we're going to talk a little bit about captives and insurance and really kind of the concept about stop loss specifically, and how we can potentially start to get refunds out of it, because it's one of the last insurance products as far as all the products that you put together, at least the main ones, on a health plan that does not return money back. It's basically still just a bunch of cash going out, and if you run well, too bad, kind of like a fully insured plan. So we thought the idea would be great to have a conversation about what that would look like. And so, as I mentioned real quickly, and also mention this also, if you have questions, go ahead and raise your hand, and we'll try to answer them if we can. There's a chat log over there as well if you want to kind of type in a little message that way, whichever is easier for you. We'll share these slides though too for you, so you can be able to see this. But there's obviously a really big distinction in health plans. The two biggest things when we're talking about medical insurance is the difference between being fully insured versus self-funded. Fully insured is a very risk-adverse type of a program where the insurance company and the employer have a contract together. The employer is paying monthly premium to that carrier. Insurance company pays the claims and keeps everything after that. There's no risk to the company because the insurance carrier is actually a fiduciary of the plan. It's their responsibility to do everything right as far as paying claims, making adjustments on appeals, funding the plan appropriately, all those kind of things, and also being the plan sponsor. On the flip side, and the other piece of health plans that are put together is self-funding. And there's a lot of versions of self-funding. Healthcare reform really sparked a bunch of new versions that have popped up. But the bottom line of how a self-funded plan works is that you've got an employer who is now the fiduciary and the plan sponsor. They're funding the claims, and they're typically using a third-party administrator or a TPA to pay those claims. The employer is assuming the claims risk, but they're limiting their risk using stop-loss insurance. And so in reality, if you think about it on a fully insured basis, employers are still paying the monthly premium. It just depends on how much of other companies are helping them with paying those premiums as well, like in a community-rated kind of a scenario. In self-funding, the stop-loss is kind of your community-rated scenario. So those are the two biggies. Everyone loves Bart in the middle, and this little slingshot thing that's going on. So one thing that I've continued to find that's interesting and been following for some time is the amount of companies that are switching between fully insured and self-funding, basically trying to say, what's the trend of how many companies are self-funded versus how many companies are not self-funded? And what this report is showing you, and it comes out annually, it's based off the 5500 data, which is basically an IRS form that if you have 100 employees enrolled in a health plan, you're required by ERISA law to submit what your health plan includes, okay? And so what these stats are looking at is that how many of those health plans, those companies with 100 employees or more enrolling, determined or reported back that they were fully insured one year, and then the next year they switched, and vice versa. What you're seeing there in 2014 is a switch of the number of plans basically switching to self-funding from being fully insured, and it maintaining. What's kind of interesting, you kind of look at this grid, and it, even though it 2009 with healthcare reform kicked in, you saw some people switching to being fully insured. I mean, that's kind of spiked, but then it started to follow itself, and then it crossed over. And what we're still waiting to see is what happened in 16 and 17. This data does take a little time. This isn't just an old report that I was trying to prove a point. It's actually, it comes out of a big actuary think tank that reports back to the IRS every year on the report. So they're basically about 3 to 4 years behind because it takes that long for all the information to aggregate. And so there's a real big period of time, because you never saw it before, that you had more companies switching to self-funding. And when we talk to companies that are doing it, they're, the question is why? And every single time it's coming up with, they want to control plan design, they want to control their costs. They don't feel like the insurance companies are doing a very good job of it, okay? So as I mentioned earlier, when you're talking about self-funding as an employer, you can limit your risk by using stop loss, Okay, and the stop loss basically comes in two main forms. One is specific, which basically deals with the shock claims, the big ones that just kind of pop, like a cancer claim, heart attack, that kind of stuff. And then you also have aggregate insurance, which is basically all of those cancer claims and heart attacks and everything together. That's the worst case scenario for an employer, that if they would have to use their aggregate stop loss. But it is a contract between the carrier and the employer, and it's not an insurance contract at all with an individual, because again, the employer is the fiduciary and the plan sponsor. They're responsible for funding the claims, and so they're the ones having the contract to be able to handle this stuff. Okay, very, very common stuff. Actually, you may or may not know this, but on a fully insured plan, they actually have this insurance too. So even though it says you're fully insured, the insurance companies actually have more insurance to be able to protect themselves against these big claims. Okay. And we're digging in a little deeper about specific stop loss. This is, a couple more pieces of information if it's new information to you, because it's going to be real important when we get to the illustration on these captives and how they all work. And I'll pull this all together here in a bit. It maybe feel like I'm getting a little wide on the questions, but or comments, I guess. But I just wanted to get you some background here. The spec is going to actually cover the employer's risk for each participant. As I mentioned, it's kind of a shock claim kind of a scenario. So each member of the plan, each participant of the plan has their own specific stop loss. The employer is actually setting that specific or individual deductible or participant deductible, and it depends on how big you are and how much cash flow you have, and how big your reserves are and how big your spec deductible may be set. If you're a company, let's say 100 employees and you're self-funded, you may have a spec of 50,000. If you're a 500 life company, you may have a spec of 200,000. But the employer is going to be reimbursed for claims that exceed that deductible amount. So as I mentioned, if you're that same company with 100 employees and you got a $50,000 spec and you've got a MS patient that costs $125,000 each year, you're going to have to fund the first 50, and then the insurance company is going to, the spec deductible will kick in, and that insurance company will kick in the difference between 50 and 125. Okay. Normally, because there's more of those types of claims that happen, and as healthcare reform has not done a very good job of controlling price when it comes to healthcare, your spec deductible or your spec insurance is going to be your largest premium up between that and aggregate. Okay, it's actually one of your largest fixed dollar costs when you're looking at self-funded plans. When you're talking about aggregate or ag, as far as the stop loss insurance, this is going to set the cap for the employer and their total claim liability. As I mentioned, it's all the cancers and the heart attacks and all those big claims, even the pharmacy costs. Because we do see companies out there that for some period of time, maybe even still now, they didn't even have stop loss at all. They're big enough, maybe like a Microsoft or an Amazon. They're going to have so much so much funding dollars, they may not have their own stop loss. But with the cost of pharmacy going up so fast and the $1 million claims that are starting to see there with the cancer drugs, even the biggest companies now are starting to set some aggregate or some spec type stop loss insurance just on pharmacy alone, which is a real interesting trend. But basically with your aggregate, you're capping your cost as an employer. Typically that cost will also determine what your expected claims are. So when the stop loss companies are looking at you as an employer and your claims history and trying to say, okay, so how much do we expect? Because if we set your spec at say $50,000, what would we expect to have to pay out on claims? And so we need premium to be able to fund for those claims. Okay, pretty simple, straightforward stuff. So their actuaries go to work and come up with what that number is. Typically, your maximum exposure is about 125% of that expected claims for that plan year. Okay, it is a small stop loss. It's your smallest amount, significantly smaller than your spec premium. And this is actually an interesting thing. We see this pop up in certain states. It does, like the state of Washington, does require that you have aggregate stop loss. It doesn't matter how big and bad your company is, you still are required by the state of Washington to have stop loss on an aggregate form. And so we see that pop up every once in a while. So that's just kind of a little fun fact, something to be aware of. So talking a lot, pictures are always better. Lisa's always great at explaining stuff because she's really, really smart, smarter than probably everybody. And this is just kind of in visualization. So let's just stay with that same 100 life company that has a $50,000 spec, and that's what we're illustrating here. all those little blue columns there are basically all the little claims that are happening underneath the 50,000, except for that big monster one that's going up in orange. I'm not exactly sure how high that's going. Let's say it's 190,000, but the specific stop loss would pay for that claim after $50,000. Okay, pretty simple, straightforward illustration. Perfect. All righty. Okay. This is kind of interesting fact too. When we had some questions the other day for a couple of stop loss carriers, and we said, hey, let's go ask the question of the top 3 stop loss carriers and how often do they actually have aggregate claims? Because employers are questioning why in the state of Washington they should have to actually have aggregate. So we reached out to them, and the top 2 actually said, well, actually we don't even have any stats because it never happens on that. And so the 3rd largest stop loss carrier in the country came back and said, well, this is kind of interesting. When we actually look back at our book of business, less than 2% of the employers would ever expect to have an aggregate claim in 100 years of being self-funded. So that's a pretty low number, especially when you're forced to have to buy some stop loss for it. Okay, so that was some good information. Maybe may not make you feel very happy. Then Homer jumps in and says, well, that's interesting. So if we don't have all these claims happening, have you ever seen your stop loss premiums really go down? Or have you ever received a refund for your stop loss? Yeah, you can go get a refund contract quoted with the stop loss carrier, but they're just going to jack your premiums up so they can offset their profits. Okay, there isn't a medical loss ratio requirement inside of stop loss, so it's kind of an interesting question, and this is kind of always a favorite little thing. When Homer does the dough thing, and I saw this little picture and I thought it was kind of interesting that word, the D-OH exclamation point, is actually a real word in the English dictionary. You wouldn't think so. I guess, if ain't is considered that it is, then dough must have to as well. But, it's an annoying grunt, which I think a lot of us feel when we're looking at stop loss insurance and the costs that are associated to it, particularly when there's no way to really get our money back, okay, for the most part. So that's why we want to start considering captives, okay? This is something that has been around a long time. You see it a lot in the commercial insurance side of things. Health insurance programs have been starting to pop these up a lot more as more and more companies become self-funded because there's more opportunities to come together. So what is a captive? A captive technically is an independent insurance company, okay? They're created and owned by at least one non-insurance company, okay? So that means like a regular private employer can be a captive, or another entity can be a captive that's not actually licensed as an insurance company, to assume the employee benefit risk of the captive owner or owners. And so most of the time when you're talking about a captive, you have multiple organizations, multiple companies that are underneath this one entity that's called a captive and purchasing together. And so incorporated as a captive into a plan strategy allows members to benefit from being owners in an insurance company, including redistributing profits, i.e. refunds, okay? So basically what I'm trying to get at, and I'll have a visualization of this here in a second, is that if you are part of a captive, you're part of multiple other employers that are like-minded and wanting to get returns, controlling their costs, and having the ability to still control their own plan designs. And I like to use the term, because I think it's kind of simple, because we've heard stop loss a bunch before, is that captives kind of turn into a second stop loss coverage. Okay, they're kind of a layer of a second stop loss. So what do I mean by a second stop loss? Cash flow, right, is really what I'm talking about. If you're a company, that's considering being self-funded, cash flow and reserves are key factors in determining how much risk or how high you can set your specific deductibles. Still use that same 100 life company again. Usually a 100 life employer company, let's say they're a manufacturing organization, is not going to have cash that's just, on a money tree that's outside that they can go spend on whatever they want to do. And if they did, they probably don't want to spend it as much on insurance. And so they're going to kind of be limited on the specific deductible that they can take on, which means that when we normally change plan designs, we take on higher exposure. Well, there's not much more exposure you can take on because you can't fund the specific claims that are happening underneath that. Okay, so you're kind of stuck. You can't raise it up enough, and the insurance companies keep lifting your prices every single year, and you may not even have any claims against it for the most part, okay? But we do know, because of healthcare reform, we're starting to see more and more claims that are growing to become larger that might have been much smaller in the past. And so they are starting to hit a lot of those claims underneath that spec, and they're starting to chew up cash flow and reserves more and more. That's why you see these really monster companies starting to put stop loss on their pharmacy, because the number of cancer claims, the number of $1 million claims that happen because of cancer are chewing up their reserves. And so they put a stop loss on there to reduce their risk. Okay. Even the big companies are doing so. The small companies kind of need their own version of it too. So what the captive does, it actually is going to take on the risk of the employer specific deductible. And so they're actually buying that higher specific deductible. And I'll show this in an illustration here in a second. But that's why I call it a second stop loss, because it's basically funding a certain level of what you had your spec at before, and you're able to buy a cheaper stop loss, a specific stop loss coverage, because your spec is much higher than it had to be. And since you got multiple employers in that captive, you got money that's in there funding that captive layer, that second stop loss layer, and then the organization, the captive itself, actually has the ability to redistribute the money back to the employers that are participating in it, really as a refund on what I would call a stop loss, even though it's not technically stop loss insurance. So let's bring Lisa back into this thing and actually kind of make this make sense a little bit more instead of me talking a whole bunch. So same $50,000 claim, okay, but instead of the employer buying the specific at the $50,000, the captive actually starts paying at $50,000. Okay, so all those employers in that same claim are paying in to be able to fund the difference in this case from $50,000 to $200,000. So now the employer is buying their spec at $200,000, and all the other employers are funding all the claims that happen inside between $50,000 to $200,000. Okay, so there's the employer stop loss on top right there. And then at the end of the day, if there's money back, because everyone's been funding in for all these other claims that might be happening, then the organization, the captive, can determine how much to redistribute back to the organization, to all the rest of the companies as they participate. And a lot of times it's based off of the volume, maybe the number of employees that you have participating in the captive itself. And so it'll be pro rata essentially on the refund. Makes a lot of sense, I think. So sometimes the question is, well, I'm already self-funded, so can a captive work? Well, I think as we've described this whole thing, and I love the picture of Marge. It's always, growing up, I always remember kind of her little grunt sound when she was thinking really hard, or Homer did something stupid. But this is kind of a funny picture to me. But would a captive work if I'm already self-funded? Well, yes, of course it would. And if the expense is the fixed cost on it, makes sense, because if you have to fund into the captive, then there's a fixed cost that are associated to that. So you have to figure that out, plus your actual new spec deductible, to see if this makes sense. But what it's going to actually be able to allow you to do is lower your current spec stop loss risk and insurance premiums, okay? Which is then going to give you additional resources to fund the high dollar cost claims, and you can participate in a program with other like-minded employers. And so one of the things that we see with the captives is that there's meetings. These organizations have to come together to talk about the performance of the captive, to say, are we going to do a refund or not on this thing, or do we need to keep it in there? Well, as you're together with these other employers, you're going to come up with other programs that have been vetted out and determined that, hey, these actually help this employer. Why don't we actually make this part of the captive and bring this in-house? And because we have a much larger buying pool, we're accessing benefits that you can't get on your own. Okay, pretty cool. And then you can receive refunds again on that second stop loss. So I would say, yeah, it's something to look into, particularly if you feel that you're being pinched on the ability to change your specific deductible, or to be able to lower your premium enough and needing to increase your specific deductible, meaning if you're already self-funded. So let me conclude this. I think the session was set up for about 30 minutes, and we're getting close to the end. But in conclusion, if we're talking about these captives, and I guess I never introduced myself, but I can do that here at the end and do it in reverse of how you normally do these things. More companies than ever, as we already saw by the 5,500 data, are changing from fully insured to self-funding because they really want to control their costs. They also like the idea to be able to determine their plan design much more than just picking max out of pockets and that kind of stuff. You can adjust co-pays, you can adjust the type of programs that you're offering to your employees, because you may have a special population that could be benefited from a special provider that you can add in that you can't get on the fully insured market. And so that's why a lot of, we're seeing that change happening. So there's a lot of opportunities that exist to get to be able to try to find the highest value to keep the health plan performing as well as possible. And when you perform well, you get your medical claims coming back. That's why companies go self-funded. There's no reason to do it, otherwise. Why take on the risk? Same thing on the pharmacy side of things. I mean, there's rebate programs out there, and there's these pass-through type of PBMs that exist that can help you reduce your overall cost. And I can tell you, these things win all the time. You're never going to get that in a fully insured basis. They're always just going to keep all that money, right? So that's another reason why they're doing it. So why not also on the stop loss side of things? Why not make your full plan as high performing as possible, returning the best result back to the organization so you can reinvest that into other things that the company determines is what they want to do, okay? We know that prices for healthcare is increasing rapidly. You might have seen a presentation from the state of Montana and some of the things that they're doing that are pretty innovative and aggressive probably at the same time. But the bottom line is that we can keep on trying to get our employees to use the health plans, to not use the emergency room, to not use the urgent care, to go get primary care, all that kind of stuff, to keep finding the cheapest way with the highest outcomes to improve utilization. And then, quite frankly, if you look at the stats that are out there, utilization has continued to become more and more efficient. So we keep driving efficiency in the system, but the prices keep coming up, right? So I mean, normally when you do something as an organization, you're trying to drive efficiency so that you can get a better return. Well, the returns are getting worse. And so we got to figure out a way to solve that problem on a long-term basis. But in the meantime, we need to solve today's problem, okay? And today's problem is dealing with how do we deal with the pinch that we're feeling on our specific deductible, taking on new lasers because these new claims and those kind of things is ultimately causing problems for our cash flow and even impacting our reserves. And so captives can be a solution for you for that, to be able to deal with helping the cash flow, because your fixed costs will go down on your spec stop loss, and maintaining or even returning specific deductibles from before, okay? So sometimes you see companies that they've continued to take on the risk and they're getting a little uncomfortable because their spec is getting so high. Well, they throw the captive layer in there, and now all of a sudden they're back to a level that they feel better on it from a funding and a reserve level, okay? So you can kind of work backwards that way too. And all at the same time, and here's the other thing, the captive typically doesn't tell you how your plan design has to be developed. Most of them don't. So you as a company still get a design, what deductibles and copays and programs and that kind of stuff. And the captive might bring other programs that are going to help you control your cost and be able to offer better benefits and outcomes to your members, okay? So that's really our presentation today about captives. We wanted to bring this up as an opportunity for people to see, what is this thing all about and how does it work? Really to answer that question, that you have to do an analysis on your organization and get it quoted to figure out, what is the captive cost going to be? What's my new spec cost going to be? And be able to run those numbers. And we're more than happy to do that. As I mentioned, I guess I forgot to introduce myself. I'm Tyson Fuehrer from Biggs Insurance. I'm the vice president here in charge of the benefits department. I've been working on these self-insured programs for a number of years and really enjoy organizations that are wanting to engage in this process. Fully insured is fine. There's nothing wrong with it. But we find with the member companies switching over to self-funded, it's really a good time to be doing a lot of consulting and strategy work with our customers. And so my email and phone number is there if you want to reach out. I'd love to talk to you and see kind of what you guys are up to, what's impacting your business, and what we can do from there. So that's our presentation for today. I hope you enjoyed it. Throwing the Simpsons in there might make it a little bit more fun for the rest of us, and look forward to having some future conversations. Thank you.